Hello and welcome to this very special show. 2008 was a year of bust. 2009 unexpectedly turned out to be a year of recovery for most asset prices. How will 2010 pan out? That's the question we will try and answer with one of the foremost financial authorities in the world, Dr. Marc Faber. Dr. Faber, thanks so much sir, for taking out the time for us. Are you surprised by the ferocity of the recovery in asset markets across the board?
When you print money, anything can go up. Obviously, stocks were oversold and commodities were oversold. So especially stocks and commodities then went ballistic after March. And we had, from the lows, in many instances, 100% or more recoveries in individual stocks. Even poor companies like Citigroup went from $1 to $4.
Right. How will 2009 be remembered in your assessment compared? I'm going to come to 2010 later, but
yes,
we are up 100% here in India, for example. So it's as if the entire crisis never happened.
Yes, exactly. But I think that 2009 will be remembered by two groups of people. The fund managers that were right. They went long equities at the beginning of 2009 and long commodities, and they've done well. At the same time, they went short the US dollar. And then there are other people who believed when in March the market began to rally from 666 on the S&P, they thought it's a bear market rally, and they were under the influence of the deflationists that believed that the S&P would drop to 400. It may still happen one day, but it didn't happen at that time. And so they were long US government bonds and long the dollar. So they were wrong on every count. Long government bonds in the US, long the dollar, and out of equities. And so these people, they will remember 2009 as a disastrous year for them because they missed the whole bull market.
Do we read too much into 2008, 2009? They say past performance is not is an indicator of future returns. So 2010?
Well, I think that if you look at major recovery moves following bear markets or following recessions, like 73, 74, we had a recession. Then 74, 75, we had a huge recovery move. We had a huge recovery move after March 2003, as you know. And we had a huge recovery move after August 1982. Usually the first part of the recovery, the first, say, 9 to 12 months are the best. And we had in India, as you know, the indices have doubled from the March lows. I don't think they'll double again over the next 12 months. Can the indices move up another 20% before we have a correction, or will they correct here and so forth? That we don't know for sure. But in general, I think the gravy is out of the markets. We have had huge moves, and the people that missed them, too bad for them. Now, going forward, I have some concerns because basically the stimulus will wane, the impact will wane over time, and sound a footing thereafter. And so I think that more quantitative easing, more stimulus packages will be necessary, and that may boost actually asset prices, and it may lead to high inflation rates at some point. But it may not make much difference to the typical household in the Western world whose standard of living is going down.